Hello, and welcome to this week's edition of the Big Money Show, brought to you by Big Financial Services. I'm your host, Kristen Oakley, and joining me in the studio is Glenn Cummings, who is the president of Big Financial Services. Glenn, my friend, I look forward to this time with you each and every week, as I know our viewers do. Great to see you again.
Kristen, there's only one thing I have to say to start the show, as I do every show. Are you ready?
I'm ready.
Let's go!
Let's go!
Let's go! It's going to be a great show. So excited to be here today.
It is going to be a great show. And if you are at home and you are newer to us, buckle up, you're in for a treat. We're going to be talking today about market volatility and your retirement date. Now, you might be thinking, how exciting can this really be? Oh, it can be very exciting, right?
Very, very exciting, very exciting. You know, a lot of times when I sit down with clients, the main concerns they have is market volatility, and you should be concerned with market volatility because if you're planning on retiring, say a certain date and time, and all of a sudden we have a 2000 or a 2008 happen, that could really be completely detrimental to that retirement outcome that you're looking for.
Yep.
So, you know, we look back at 2000 and 2008 and realize that a lot of folks had to work 7, 8, 9 years to get back all of those assets they lost in that down market.
Right.
But one thing I always try to tell people is, whenever there's a down market, don't sell, and try not to, because when you sell is when you lose.
And that's when you lock in that loss.
You lock in the loss. But if you don't sell and you kind of ride out some of these waves that generally are in our markets, depending on what, of course, you're invested in, that always depends as well, buying or selling something. But if you're in good companies, good fundamentals, and you ride these things out, in a lot of cases, they will come back. In a lot of cases, you're going to be okay. So you have to be very, very careful, but the people in 2008 that sold, a lot of them didn't recoup. The ones that didn't sell that stayed in are up 400+% since then. So you can recoup your assets. But when you look at diversification, you shouldn't look at keeping every dollar in the markets. You should look at diversifying, look at other instruments, look at other things that may be available, look at real estate, look at CDs and banks. They're paying a pretty good rate of return right now with no risk, right? Look at fixed annuities, fixed indexed annuities. They may provide you some better growth over time to your money without losing it, depending on the claims paying ability of the life insurance company and their ratings. You have to look at all those kind of things.
Right.
But there's a lot of instruments out there to look at and to diversify. And the other thing, too, is a non-correlated portfolio is something that people out there don't even know what that means.
Yes.
Non-correlation means I don't want to be all in, just one thing, that if it goes down, I lose a lot of money.
Right.
I may want to be in some equity positions, but also be in some bond positions that if equities are going down, bonds may be going up, right? Or bonds are going down, equities can be going up. So it's more of a diversified type of portfolio that can help you in a lot of things. If I own domestic stocks here in the United States and our domestic stocks are having a little dip and valley, I may want to own some international stuff. I may want to own things that aren't domestically here. A lot of people like calls for gold and silver, right? There's all kinds of ways to diversify your portfolio. But what I get afraid of is everybody putting all their eggs in one basket.
Yes.
Right?
Yep.
And in a lot of cases, that's where people really get hurt, is when they put all their eggs into one basket and they don't diversify properly, especially when you're close to retirement, Kristen.
Yes, and it's true diversification. I think one of the things that a lot of folks don't understand, what you just spelled out, which is so awesome to really walk through and help people understand, that it's diversification by asset class.
Yes.
Because some people think, oh, I'm diversified. I've got 5 different mutual funds.
Yes.
But when you peel back what you're invested in each of those funds, a lot of times folks find that they have a completely correlated portfolio and don't even realize it.
Have no idea. And in a lot of cases, some people will say, well, Glenn, I like small cap stocks, or mid cap stocks, because those may provide me better growth over time. Why is because, some of those companies that are smaller, right? Not everybody invests in those. So some of those companies can possibly provide a better growth over time, but also more risk.
Right.
Right?
Yep.
More losses can occur. Where if I own some large cap stocks, some of these larger companies that are out there, the benefits of that are those are companies that have been around a while. Right? Those are companies that we can look and see the retained earnings, just like many other companies. But having people behind the scenes that can do a lot of that research for you is a very powerful thing. And, you know, I had a couple that came in to my office recently, and you know, this gentleman, you know, we did what we call a portfolio analysis. He gave us all of his investments. We did a complete Morningstar portfolio analysis, and I looked at his returns over the last 10 years compared to some of the other returns of some of the other portfolios that we look at for clients. And when he came in, and for that second meeting, and we did the full analysis, him and his wife were sitting there. We had a nice fresh cup of coffee. You know, we got a beautiful, beautiful office with a big screen there, and we were showing portfolios and things. I was blown away. And they were more blown away when I told them, hey, look, I don't really think that I can help you, you know? And he's like, what do you mean? I was like, well, you're doing a great job. You know, if I look at your portfolio compared to some of the ones that we look at, that we manage or our group manages, you're doing great, you know? And I said, I don't know if I can help you. And he says, well, thank you so much, Glenn. And his wife goes, but Glenn, you don't understand. We've got a major problem here with my husband. Well, what's the problem? Every single morning, he's up at 4 a.m.
Wow.
He's looking at the commodity futures markets. He's looking at the Dow. He's looking at all this public information that's out there, because a lot of information that causes the markets to go up and down is public information that's put out there, right?
Pulling those levers, right?
Pulling those levers all day long. He's sitting in his computer. When the markets are up, he's happy. When the markets are down, he's not so happy, right? So she's just all by herself in this beautiful house. They have a substantial amount of savings, but he never lets her spend any money because he's always worried about losing it, right? And he's caught in this situation where he feels that no one else out there can do a better job than him. So after we shared some of our different plans and those different things, and shared some of the different alternatives, and I said, you know, hey, why don't you let us work with you to do a little bit of business? We don't have to move everything over. You're doing a great job. Now he's out enjoying himself. You know, he's able to get out there and play golf. He's able to go out to dinner more often. It has literally changed their lives just by making a few tweaks, okay? So if you're out there and you're working hard and you're doing a great job at this, and you feel there's no help out there, not only me, there's a lot of great advisors. Interview some other advisors out there. See what they offer. See what you're in, and see if there's ways you can help improve your retirement, because it's not about how much money you have. That's great, okay? The more you have, that's great, but it's about how much I can spend, you know, how much I can actually truly enjoy in my retirement and relieve a lot of the stress that's always on our shoulders. He was always stressed, right? She couldn't really enjoy their retirement together. But anyway, so that's just one story. There's so many, Kristen, that I have. It could be 3 or 4 hours today.
I know, right?
But yeah, I'll, you know, but anyway, everything you said there is perfect. Yeah,
Well,
the asset class you're in is very important as well.
For sure, but I love this, Glenn. I love that your clients have the peace of mind of knowing that you are watching it for them, right? Because I think that's the challenge for a lot of people that try to do it themselves. It can be all-consuming because you have to be watching it all the time.
All the time.
But when you're able to hand that off to someone with your kind of expertise who has their best interests in mind, that's a game changer.
It really is. And you know, the thing I always say to clients as well is we're considered a fee-only fiduciary advisor. We're not considered a broker. So I'm not a broker dealer, so we're not charging commissions on things. We receive a small fee, which is called assets under management, to manage your money. So we have an incentive to hopefully have your money grow, right? Where if we receive a commission based on the things we sell within your portfolio, if they go down, we've still been paid, right? So you want to work, in my opinion, with a fee-only independent fiduciary that is working in your best interest. And as your portfolios grow, our fee will get bigger, right?
Because it's by percentage.
It's by percentage. So there's an incentive to try to help you into the best things. But also, what I like is that clients that decide to work with us on that management side have the opportunity to leave us. You know, you might not always like our company. You may not like me. I may say a bad joke and have some fun with you. And you may get mad at me and say, Glenn, I'm going back to this other company. You know, your money's fully liquid with us, right? So wherever you want to go, you can take it with you. And that's also something that clients are very happy about as well, is that, you know, we are responsible to earn your business, right? And it's okay, folks, to be selfish, right? It's okay to say, this is my life savings. This is what I've worked my entire life to build. And I'm going to be selfish, right? I'm going to check out not only Glenn, but I'm going to check out some other people. And I'm going to get second opinions, and you should do that at least once a year, I would imagine. At least have someone give you a second opinion and review whatever is available out there. And if you don't feel that I'm doing a good enough job or someone else is doing a good enough job, move those assets to someone else you feel better with. And we're really fortunate. We don't really lose a lot of clients because we're always transparent. We're always available. Yeah, we love to work with folks and getting second opinions, looking over what you have, making sure you're making adjustments is very, very important as well.
Yes.
Very, very important as well.
For sure. Well, I know that you are generously offering this complimentary written financial plan to our viewers. Talk a little bit more about what folks can expect and what they're going to receive from that complimentary time together.
Well, we're going to sit down. We're going to have a cup of coffee. I hope you like coffee, okay? Because I like coffee, all right? Or we'll get you a soda or something. I don't know if we should get them a soda. So, whatever you do, you come in the office. We greet you. We welcome you. It's a beautiful office. Like I mentioned before, we have a nice, big, beautiful oak trees all around my office there. We have a nice big screen. We can sit down and we can go through pretty much everything, and we can formulate a plan for you, a written income plan to say, okay, here's how much assets I have. Here's where my money is. Here's my goals. We put together budgets, okay? Because a lot of times people don't know how much they can spend because they don't have things budgeted. So I like to budget in travel. I like to budget in, a new roof. I like to budget in a new air conditioning system, taxes that are going up, insurance costs are going up. So we need to budget in a lot of different things and also formulate that plan. And you need to meet with your advisor generally every 3 to 6 months to kind of formulate and make sure we're on track, right? So not only in our written plan do we say, here's your written income, we want to make sure we know exactly what could happen if you were to lose your spouse, because generally if you are married and you lose a spouse, you're going to lose some type of income. So we want to formulate that in. We want to look at long-term care as a possibility. When we get older, we may have to worry about covering those costs. So where are we going to get the money to cover that? Do we want to have some longevity to where things are going to last the rest of our lives with income? There's certain plans that can offer that. So, and taxes are probably the most important thing, reducing those taxes in retirement, because the bigger your taxes are, the bigger problems you're going to have with generating that income because the IRS has taken a chunk of it.
Right. So important to look at all of these things. And
Yes.
I'm excited to continue this conversation with you. But this is a great opportunity for those of you that are watching. If anything has resonated with you, if you know that it's time for you to get a solid plan in place for your retirement, we encourage you to pick up the phone and call that number that you see on the bottom of the screen to claim your very own complimentary written financial plan. Simply call 888-503-7408. Or if you have your smartphone handy, you can simply pull it out. If you open up that camera app, just point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Big Financial Services will reach out to connect with you to schedule your complimentary meeting that way as well. Don't go anywhere. We've got a lot more to cover on today's show. Stay with us. We'll be back right after this.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to the Big Money Show, where today we are discussing market volatility and your retirement date. I'm your host, Kristen Oakley, here with the president of Big Financial Services, Glenn Cummings. And here's the reality that when you are approaching and nearing retirement, it is more critical than ever to be making sure that you are taking the appropriate amount of risk based on where you are in the retirement red zone that we like to call it, right?
Yes, it's called the red zone.
Yes, that 5 to 10 year window out from retirement. And I know that a lot of times you have folks that come and meet with you, Glenn, who have a date in mind of when they want to retire.
Yes.
Walk me through a scenario where someone has come in and said, Glenn, this is when I want to retire. And then how do you build a plan accordingly based on when they want to pull the plug on their working time?
So you primarily want to do a budget first, right? Okay. How much do you need per month to be comfortable, right? Traveling, all those kind of things. So a lot of times it's like, okay, before we jump into the budgeting, before we jump into all these things, what does your ideal retirement look like for you? What are the things that you want to do, right? So what is a perfect day to you? Well, Glenn, a perfect day to me is heading to the beach or going on a cruise ship, right? We want to make as many of those perfect days as we can. So let's focus on creating a retirement that you're really going to truly enjoy, number one.
And I love that because there's no wrong answers, right? It's really dependent on that person and what they want to do.
Yes, what they want to do. And so once we kind of figure that out, what their dreams and their hopes and their goals are, then what we're going to do is we're going to do a full budget. We're going to say how much income do we have coming in? When are we planning on turning on Social Security? That's a very important part of a plan, okay? How much assets do we have? And where are those assets? Where are they? And in a lot of cases, we will do an analysis or a risk analysis for the client where we can just send you a little questionnaire and it'll come back with a risk number from 0 to 100. So say you're a client that, you're more, you want to earn some interest in returns, but you don't want to lose too much, right? So say, you want to make, say, 8 or 10% a year returns on your money, but you don't want to lose more than 10%. So maybe you're a 50 out of the risk number from 0 to 100. Then we take your current portfolio, your current 401k statement, and we have it analyzed to what is your actual risk where your money is currently. And a lot of people don't even know this.
Right.
And I promise you, there's probably such a discrepancy between what people are comfortable with in risk and where their portfolios are. The people might be a 50, but their portfolios are an 80. They've got way much more risk than they're comfortable with. And then we could say, hey, look, based on this portfolio, if we were to go through another 2000 or a 2008, how much could you lose? How much are you comfortable losing? And that's a really powerful thing. So then guess what? We look over it and we say, okay, maybe we need to make some adjustments here. Maybe we need to reduce the risk now since we've already reached this plateau, okay? So that's a very important thing to do. Figure out what the risk is and then build the plan and formulate the plan with income, with less taxes. It's a pretty big process. And a lot of times, folks, a lot of you are just out there scared to go through the process. You're in fear, you don't want to look at the reality, right? We want to make the reality come true in a good way, right? So come in, sit down with us. We're going to teach. We're going to educate you. We're going to show you where things are invested, where your risk is, plans and tools and ideas that may help reduce that, and give you peace when you leave our office. And it may be 2 or 3 meetings. Sometimes this takes a month or two of multiple meetings, sitting down and taking our time, being completely transparent. I'm going to give you so much stuff to go home and read. It may drive you nuts, okay? So you got to have the patience to go through all this stuff because we're going to teach you and educate you, and we're going to share a lot of different ideas. And then when we formulate that plan, we're going to keep up on it. We're going to make sure that we get together all the time. Things do change. It's very, very important.
Absolutely. Constantly tweaking, making those adjustments.
Tweaking and making the changes, absolutely.
Yeah, for sure. Well, if you are watching and you're going, you know what, I don't even know how much risk I'm currently taking. Maybe I'm taking too much. Maybe I'm not taking enough. enough based on my age and stage of life. This is why it's so important to have it in writing. So the offer for you today is to be able to call in to get your complimentary written financial plan. As Glenn said, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how he and the team of Big Financial Services can help and serve you. To claim yours, that number to call is 888-503-7408. Or again, you're also welcome to scan that QR code and that will get you connected as well. We'll be back with more on The Big Money Show right after this.
Good morning, Ben.
Good morning, Ben. Hey, birthday party for Carolyn 5. Happy birthday to you.
Good morning, Ben. Happy Monday.
Daryl's birthday, be there or be square. Happy birthday to you. As you can see from our quarterly report on slide number 62, we're trending in the right direction. All signs point to a very positive outlook for the next several years. If you peel back the onion
Ben, do you have anything to add?
The work never seems to end until the day it finally does. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to The Big Money Show, where today we are discussing market volatility and your retirement date. I'm your host, Kristen Oakley, here with Glenn Cummings, president of Big Financial Services. And Glenn, I want to go back to something really fascinating that you said in the previous segment that I want to make sure folks understand. You were talking about how a lot of times when people come in to meet with you for the first time and you're able to show them what they are actually invested in, a lot of times folks are shocked and surprised to see how much risk they are currently taking. A lot of folks have no idea. There's something interesting that happens too when you put a monetary amount to how much they could potentially lose. Talk about that process and kind of some of the ahas that go on when you're able to do that in-depth analysis for someone.
You know, it's so funny because in our first meeting with clients, we have a little worksheet. And it's a real simple worksheet, nothing really exciting, but you know, we simply plug in the amount of money they have in the market, which I consider the red zone.
Right.
You know,
Yeah.
it's not really safe, but it provides opportunity. So I'm not saying I'm not a markets guy. I love the markets. I love the opportunity it provides. But when you get closer to retirement, you have to kind of be careful there and make sure you make the right moves, right? Because in that red zone, there could be some significant risk, right? And I always talk about us being literally at a blackjack table playing blackjack, right? We don't know if we're going to win all the time, right? So that red zone is a certain amount of money. So what I'll do is simply plug in that amount of money, and then what it'll show is okay, if the markets go down 10%, what's that exact amount I would lose? Right. Markets go down 15, 20, 30%, right? So we put that together and I literally sit it in front of you and you look at it and I say, now, my question to you is, you mentioned that you're okay with volatility, right? Because many of us that are in the markets are. We understand the markets are going to go up and down.
Right.
You may have been through a 2008 and hung in there, right? And I ride out the markets all the time, but where are you comfortable? How much are you comfortable losing if we have a negative market, right? And we are in a cyclical cycle. What I mean by cyclical cycle is things have to come up and things have to come down, which is why rising interest rates occurred in the last couple of years, and they're still kind of high, because they wanted to slow things down. Inflation starts to get out of control. So when rising interest rates can cause market volatility, right? It can cause losses because people are simply moving out of the markets to go find safe havens in the banks and CDs, those types of investments, or fixed annuities with higher yields, higher rates. So it causes volatility. So I simply sit down and I say, okay, here we go. Here's how much money you have. Do me a favor and put an initial next to the amount of loss you're willing to take right now. And it's very, very funny How everyone always talks. Oh, I can handle the volatility. But when they look at how much, like you said, the exact monetary amount, the exact amount they could lose,
right,
it's very difficult for them to put an initial next to it.
Well, and I think when you say 20%, right, versus if you put a monetary amount on it, and for someone maybe that's $500,000,
Yeah. Yes.
that changes things a little bit.
Yes.
Yeah.
And then the other thing is, after they check mark that, I say to them, okay, now hang on one more second. I have one more question for you. So if you were to invest your money with me today, right, and unfortunately we had a little bit of a correction here. Things started to go south, and you lost $200,000 in the next 30 days, or whatever that amount is, are you going to give me a phone call? Or are you going to ride this thing out? I said, or you're probably going to fire me, right? You're right, Glenn. I'm probably not going to be happy. Okay, so let's carve that back a little bit.
Right.
Okay.
Yeah.
But there's a strategy that we use that is very, very unique that can park your money in something that's guaranteed for a period of time, provide a future guaranteed income, to where I may be able to take a little bit more risk in more of an equities-based position on a portion of my assets, right, if I have some protection in place.
Yes.
Okay?
Yeah.
A lot of people say, well, Glenn, what's that protection? Well, it could be real estate. You know, that could be some real estate that grows in value over time and provides some income in the future. It could be an annuity, you know, that could provide some guarantees. Of course, you need to look at the life insurance company, the claims paying ability of the life insurance company, and the ratings to make sure you're comfortable investing there. But if you have a chunk of your money that's guaranteed to never lose, that's a nice feeling. And then you can also invest the difference, maybe a little bit more equity positions that may provide better growth over time. And if some reason the markets have a little dip in value, maybe I take my money from this other investment and let this come back and grow.
Right, so that you don't have to sell at that loss. Like
yes,
we
you don't want to
talked
sell
about
at a
the
loss.
Right.
So,
yep,
great idea.
And it's also so important then to have the right withdrawal strategy in place so that when it's time to take money, you know which account to pull from, or which vehicle rather, so that you are doing it not only in the best manner possible for gains and losses, but in the most tax efficient manner too.
Absolutely. And a lot of times people say, hey, we follow the 4% rule. You need to be careful, okay? Because the 4% rule is just a rule of thumb. But if I lose 50% on my portfolio, I'm still not going to want to pull 4% out of that portfolio. I want that portfolio to grow back. So I want to allocate things to where I don't have as much loss in a bad downturn of a market.
For sure. And it's so critical to make sure that this is done prior to retiring, because once you retire, if you are taking money out and the market, heaven forbid, decides to drop right when you retire, I mean, this is what was so devastating for so many people in 07, 08.
Yep, we've seen it. And it's very, very important, like I said, to get a second opinion. You know, sit down with an advisor. Not only me, there's other great advisors out there. We're just one that you can reach out to. We're one that you can give us a call, come in, have a fresh cup of coffee, and let's sit down. And what's nice is I never charge a consultation fee, ever. So if you come into the office, sit down with us, we're never going to charge you a consultation fee. We'll share what we have, and we're really blessed to do this. I can tell you that.
Absolutely. And you know, a huge compliment to you, Glenn, and I can say this to our viewers as well. What you see on TV is what you're going to get in person, for sure.
Thank you, Kristen. Thank you, Kristen.
Absolutely. And I know you're so passionate about doing this and getting to help more folks. I'm excited for more folks to connect with you as a result of this week's show. But again, if you would like to claim your very own complimentary written financial plan, don't wait. Don't put this off. We encourage you to pick up the phone and call 888-503-7408. Again, it costs you nothing. Not getting a second opinion, not knowing where you stand could cost you everything. So today's the day. Pick up the phone, make that important phone call, or again, you can scan that QR code to get connected. We love you, Tampa Bay area. Thanks so much for watching. We look forward to being back with you next week here on The Big Money Show.